Guys, I hope you had a happy new year, and let's hope that 2023 is better than 2022. In this video, I want to talk about how the stock market traded in the first day of the year and talk about what the January effect is, if we'll have one this year, and take a look at stock market valuations and the returns going forward from a very long period of time using the Case-Shiller CAPE index. So the stock market had a really strange day today. The Dow futures were up about 350 points by about 4 o'clock in the morning when I went to sleep the night before. But they sold off on the stock market open and were down about 200 points during the day and ended up closing basically flat. Tuesday's action to me seemed kind of like the large investors, mutual funds, hedge funds are kind of feeling their way around, right? They want to get the stock market way up just to get everybody excited because most of these funds are long only, like mutual funds. So they want to get back in the market and be long and buy back some of the names that they sold for tax loss selling, let's say. So the futures were up and then they sold off all the way down to Dow 33,000. And that was kind of a support there and then bounced back up to kind of a break even. So they're kind of feeling their way around, taking it up and taking it down just to see where there are a lot of buyers and sellers to kind of figure out if this tone should be bullish or bearish going forward. So what is the January effect? Well, it's the assumption that the stock market in January generally rises. Now, that's not always the case, but the reason for it is a few different reasons. One is, like I said, most mutual funds are long only, so they are buyers at the beginning of the year, hoping that it's going to be a positive year because that's how they make their money, by being long only. So they are buying back a lot of stocks that maybe were beaten down or stocks that they had to sell at the end of the year just so that they don't show the losers in their statements to their customers at the end of the year, but then they buy them back in the hopes that they may bounce back the next year. And some other reasons are people's New Year's resolutions to invest more in the stock market, or more likely to put a piece of maybe their year-end Christmas bonus into the stock market at the beginning of the year. So let's take a look at some stats on the January effect, and then let's look at the Case-Shiller CAPE to see where we are and if prices are actually cheap right now or if they are still expensive. And on the January effect, JP Morgan notes that the effect is most significant following years where the SPX had a double-digit gain or loss, which we had in 2022. And over the last 50 years, the S&P 500 had a loss that exceeded 10% on 8 occasions, including 2022. And following those 7 times, meaning not including the 2022, which we don't know what's going to happen yet, the succeeding January produced a negative return 5 times, or 71%, with a negative about 0.6% average return. So just by that, the odds are that January is going to be a negative return by about 0.6, 0.5%, something along those lines. And if you think we're going back to the 2021 highs and Tesla mania and all that, this is a reminder that the Fed fuels all manias. And so looking at a chart of Tesla versus the Fed balance sheet, where they've been buying all these bonds and lowering interest rates over the last few years, this tells you everything. When their balance sheet increased, Tesla and all these other stocks went crazy. As their balance sheet is decreasing, well, you see what's going on with Tesla and all these other formerly high flyers. And looking at Tesla versus the ARK ETF, it's a very similar chart. Tesla and Apple is also very similar. It's just gotten to these levels quicker than Apple has. Maybe Apple is on its way to Tesla kind of levels. But here's Apple versus the S&P 500, very similar, highly correlated. Same with Apple and the NASDAQ, highly correlated. JP Morgan's early 2023 thoughts: US is likely in a bear market as long as the Fed remains active. Some investors are looking through inflation, but those with shorter investment horizons may not try to anticipate the Fed's actions. And this is something that the analyst and the Fed never actually admits or talks about, but the Fed typically tightens until the federal funds rate exceeds headline inflation. So anytime the CPI has gone above 5%, the Fed had to increase the Fed funds rate above the current CPI to crush inflation. So JP Morgan thinks the Fed will stop increasing by April, and the CPI year over year will fall from 5.5% to 4.5% in April. But that won't happen if the CPI stays high because of a supposedly tight labor market, which will accelerate inflation. So this survey of the labor market differential, net percent of responses of jobs plentiful, less jobs hard to get. So here in 99, 50% more people said jobs were plentiful than hard to get. And here we're at kind of the same level. You see at the bottom in 2009, the differential was almost minus 50%, meaning the majority of people were saying jobs are hard to get. Very few or none were saying that they're plentiful. So until this gets down to at least zero or negative, then the labor market will still be considered to be tight and risking higher inflation. So looking at forward returns, this article says they will disappoint compared to the past decade. So they say 3 items drive secular bull markets: 1, valuation expansion; 2, earnings growth; and 3, falling interest rates. The most prominent driver of secular returns are period of valuation expansion and contractions. And so this chart going back to the 1870s shows this. This red line is the S&P 500, and this blue line is the Case-Shiller CAPE, which is the cyclically adjusted price to earnings ratio adjusted for inflation. So it's like the 10-year moving average of the PE ratio of the S&P 500 in real terms. So looking at, say, this year, 2009, right here, when it dropped to 1332, the return going forward for the next 10 years is going to be a lot higher when it's at these low levels than when it is at these high levels, like in 2000, like just recently. And to get a better idea of how that works, each one of these dots is a different 10-year period. So right now we are here in this level. And so every other time period that fell into this level with this CAPE between 25 and 30, their forward next 10-year returns were anywhere from about -1 to about 5 or 6% for that 10-year period on an annualized basis. In other words, if you buy the S&P 500 today and hold it for 10 years, your average 10-year return is going to be somewhere between probably -2% to 6% per year for each of those 10 years. Now, when the stock market bottomed out around January 2009 or so, the CAPE was here, which is about 16. And you see going forward, it had 11% annualized returns. And any other year that fell in this level was anywhere from -2 all the way up to about 16% yearly returns for the next 10-year period from that time. So yeah, a lot of things can happen from any of these levels, but the lower you go, you see if you have a CAPE of 5 or 6, the forward 10-year returns are anywhere from 7 to 20% or so. On the contrary, if you had bought in March 2000 down here, where the CAPE was somewhere between 40 and 45, the returns for the next 10 years are all negative, somewhere around the negative 5%, all the way up to negative 7%. And why is that? Well, since 1947, earnings per share have grown at 7.72%, while the economy has expanded by 6.35%. So earnings per share growth cannot grow a lot more than the economy is actually growing. So because of that, stocks over the very long term have returned roughly 6% from capital appreciation and 4% from dividends on a nominal basis, meaning not including inflation. But since inflation has averaged approximately 2.3% over the same period, then the real returns average roughly 8% annually. And so this bar chart shows that pretty well. Here is the average annual return of the S&P 500 over different periods. This is 1928 to 2021. 8.48% per year on average. Now, if you take 1928 to 1999, right before the internet bubble popped, it's a little bit higher. And if you take 1972 to 2021, it's a little bit lower than that longer period. But in periods where the market had bottomed out and the CAPE is a lot lower, then the next 10-year period going forward is going to be higher returns, right? So you see that 2012 to 2021, 12.3, 2009 to 2021, 13.8, and even 2017 to 2021, 15.57%. This is not going to last forever because these numbers have to go back to the long-term average of like 8.48. So what that means is if these last 4 years or so were a lot higher than 8.48, then the years going forward are most likely going to be lower than 8.48. And so if you think about that, it makes sense because the S&P 500 is just the stocks that make up the economy, and the stocks cannot grow faster than the economy grows. So think of the economy as a person walking a dog with a rubber leash, and the dog is the stock market. Now, if that person walks at 6 miles an hour, that dog cannot go faster than 6 miles an hour. Even if he tries to, he may be able to go a little bit faster for a short period of time, but that rubber leash will stretch a little bit and snap him back to reality. And so over the short term, the dog could be right next to the owner, but see a squirrel and run at 15 miles an hour to try to catch it. But that rubber leash is going to get extended and it's going to snap him back. In the meanwhile, the owner is still walking at its 6 mile an hour pace. And so the dog may actually stop and fall behind the owner, right, during a recession or a bear market or whatever. But eventually, as the owner keeps walking, as the GDP keeps going forward, that stock market is going to snap back, or that dog is going to snap back very quickly and maybe go faster than the 6 miles an hour for a little while. But generally, over the long term, that dog and that owner are going to be walking at that same 6 mile an hour pace, let's say. And there's one more thing to remember. The Fed quantitative easing is kind of like putting that owner on a hoverboard as he walks his dog. As long as he can use the battery of the Fed, he can go a lot faster for a little while, but that battery dies out and now you're back to walking again. And so this is where we are right now. So you don't have this artificial stimulus. In fact, you have the opposite. So take that into consideration if you think any day now we're going back to the races and Tesla's going to make new highs and all these Cathy Wood ARK stocks are going to go back up and go crazy again. It's not happening anytime soon. So keep that in mind, that where we are still at a very high CAPE in the mid-20s or so, And so there is room for it to fall lower, meaning that there is room for stocks to fall lower and valuations to go lower as well. As always, this is not a recommendation to buy anything. And if you do buy something, be cautious. Don't bet the farm, and buy real stocks of real companies with real earnings and hopefully maybe even some real dividends as well. Here's to a better 2023.